With taxation at the highest it's been since World War II, strained public finances and elevated public debt, despite the government in their manifesto promising no increase in taxes for income tax, VAT and employee national insurance, given the £22 billion black hole in the public finances and with the government telegraphing tax rises, we're going to look at and see what tax changes we could potentially see and what impact this will have on your pocket. One thing they could do is a stealth tax, which is where they basically hold or freeze the limits around income tax. You can see how the limits work on the screen now, and these haven't increased since the 2021 tax year. The current personal allowance, the rate at which you pay 0% tax on, has been the same now for the past 3 or 4 years. As employees inevitably get pay rises over the high rate threshold, which means anyone with income over £50,270, they now start to pay income tax at 40% on any income above this. In the 22-23 tax year, around 11% of adults were paying high rate tax, and this is set to rise to 14% as those stealth taxes take effect. Anecdotally, as we know now, the personal allowance is £12,570, and with the full state pension close to, let's call it, £11,500, the state pension only has to rise by 10% to be above the personal allowance threshold, meaning millions of pensioners potentially, with no other income streams or pensions, may find themselves paying tax, which is really a cut in their real income. Stealthy, right? It's thought that the various pension tax relief and exemptions cost the government a whopping £50 billion. This includes the likes of pension tax relief, pensions being exempt from inheritance tax typically, the removal of the lifetime allowance and the tax-free component of pensions. Whilst Labour initially wanted to bring back the lifetime allowance after the Conservatives revoked it, on the face of it, it looks like they've rowed back from this as it proved to be too difficult to implement and that it would have had unintended consequences with the likes of NHS doctors retiring and leaving the NHS as saving into a pension and working just wasn't financially viable. There's rumours high rate tax relief could be scrapped. So let's see how this works. So if you're a basic rate taxpayer, your pension operates, let's say your pension operates a relief at source method, you receive 20% tax relief on your personal contributions. So if you want to contribute £100 pension contribution, it's only going to cost you £80 with tax relief from the government grossing the contribution up to £100. Well, how about if you're a high rate taxpayer? Well, it gets even better. Let's say Phyllis wanted to make a £100 pension contribution, so it would only cost her £60. 20% basic rate tax relief would be added to the contribution automatically, and then she can claim the remaining high rate tax relief back on her self-assessment. On the face of it, it does seem strange that high rate taxpayers get more tax relief, and there have been rumours that a flat rate could be introduced across the board, be it at 20 or 30%, for example. Another option that has been mooted by commentators and is causing those over 55 some anguish is the possibility that the government could reduce the amount of tax-free cash within a pension. Under current legislation, the standard tax-free cash entitlement is 25% of the pension fund. So if a pension's uncrystallised, which basically means no benefits have been taken from it yet, and it's valued at, say, let's call it £100,000, 25k could be withdrawn tax-free immediately. It's possible the rules around this could change and that a lower percentage could be introduced, or simply just a cap of maybe, let's call it £100,000 tax-free cash within all your pension arrangements. I can tell you firsthand this has caused many retirees to explore the possibility and inquire about taking their tax-free cash just before the budget and crystallising their pensions. Whilst our advice is always let's wait and see and not base decisions on speculation, it shows you how the constant meddling in pensions puts people off saving into them in the first place. With an ageing population and the average pension pot in the UK only being around 100k, this, for most people, this just might not be enough to try and enjoy a half decent and dignified retirement. For most married couples, assuming your property is valued at over 350k and you leave this to your direct descendants, your children or grandchildren, then usually around £1 million of your estate is exempt from inheritance tax, with the balance taxed at 40%. More draconian rumours could see the residential nil rate band removed, which is £175,000 per spouse, assuming again that the property is left to your direct descendants. This could be, as we say, it could be removed or just reduced to some level. So we could see estates that were worth, say, £650,000 dragged into paying inheritance tax. Although this sounds like a lot of money, and it is, when you consider house prices, particularly in the south of the country, many families could be dragged into paying inheritance tax. Pensions usually are exempt from IHT, and pensions can be a very useful tax mitigation vehicle for those who may have an IHT liability and perhaps they have other assets such as large saving ISAs or property portfolios. This means if they have a pension, they can draw down from these other assets, the rental incomes, maybe savings, etc., and leave the pensions to grow and compound and act as that IHT mitigation vehicle for their loved ones after they've gone. You can see how an argument could be made that it's unfair pensions aren't subject to IHT. But from a practical perspective, as pensions are in a trust structure, trying to reverse this position could be somewhat of a challenge. Other reliefs that exist for inheritance tax could be removed or reduced, such as business relief and agricultural relief as under current legislation. If a business qualifies for business property relief, then a business owner's shareholding can receive up to 100% IHT tax relief. It's possible a cap could be introduced on business relief, or the rules could be tightened, such as shares that trade on the AIM stock market that qualify for business relief could be have that relief removed or reduced entirely. If you want to know how inheritance tax is calculated and how business property relief works, watch this video.